Let's talk about working capital today. When we talk about working capital, we have to be very careful in accounting definitions. The accounting definition of working capital equals current assets minus current liabilities. But what does this really mean? On the surface, this could possibly have very little meaning because current assets and current liabilities contain items that are not operating. Our operating items are those things we need to keep our business going, our inventory, accounts receivable, our cash. But sometimes in non-operating assets, current assets, we could have non-operating items that might haven't been sitting down there for like 20 years and the business has never really cleaned their balance sheet statement. So know your numbers so you can really understand your business. There is a difference between evaluating working capital for internal use and evaluating with external financial statements. You see, when I'm looking at an external financial statement, I don't really know the inner workings of the business. So, for example, if I were to try to evaluate a public company, I go to their website, I get the financial statements. Well, I don't know as much details to really take the numbers and really put that into the calculations in a way that it's very meaningful. But however, I can make very general conclusions using the accounting formulas and just using my insight and knowledge about financial statements to say what those numbers mean. However, when you're evaluating working capitals from an internal perspective, you have more insight, you have more knowledge, and that insight and knowledge should be used to help you come up with more accurate analysis. You got to remember, your main concern with working capital when working internally is, do I have enough cash to pay my bills as they come due? You don't need some kind of theoretical definition. You really need a real application of what those numbers mean. So what do the numbers mean? Working capital is used to evaluate the efficiency of cash management in meeting the demands of a direct cost of goods or services. Because you can actually do working capital management even if you're a service business and don't have any inventory. And remember, we're talking about a direct cost yet, not the indirect cost of, like um, rent, but direct costs like inventory. However, working capital does cost us money. So for example, when you stock up on inventory, there's a cost to holding inventory. When you build up your accounts receivable, there is a cost to holding accounts receivable. So we're not trying to maximize the amount of working capital we have. Our goal with working capital is to make sure we just have enough so we can fund our direct cost of running our business, each cycle, and so that we make sure we have enough cash to pay our bills, receive our cash in time. So the more certain we are, the less working capital we need. So if I know exactly I'm going to spend $200 and sell $200 worth of inventory, well, I don't need enough all that inventory on hand. I just know exactly what my lead time is. I know when to order it and know when to have it because I know exactly what I'm going to order. If I know my customers are always going to pay on time, well, it just becomes easier for me to manage my accounts receivable. So the more certain we are, the less working capital we need. So if we even just create policies that helps us lessen the less uncertainties, it just makes it so much easier to manage. Um, Working cap, if you can halve your operating cycle, your working capital need also decreases. So that working capital management is very, very important because it really, really helps us really optimize. The goal is optimization, not maximization. Optimize the amount of working capital we need so we make sure our operations are running smoothly. We have the cash we need to buy our inventory and we don't have build up, and basically we're not losing sales because we don't have enough inventory. So now let's take a look at an example. This Excel file you can get for free by downloading the Excel file in the link below. So the yellow cell is where you enter your data. Every other cell is populated for you, so do not enter data in any other cells besides the yellow cell. The information that's needed for you is your sales, percentage of sales and cash, and this could just be rough estimations, and you can play with these numbers to see how different numbers will affect your working capital needs. Purchases, purchase of the number of purchases you pay at time of sale, what percent of inventory you sell within 30 days, and then your working capital costs, which includes your accounts payable, accounts receivable, and accounts payable costs. I'm not going to go into details here because I've talked about that in other videos, so you can go and review that to see exactly how to come up with the cost of working capital. But I'll say this, it is very important that you compute the cost of your working capital because you want to see how this cost, how this cost affects your profitability, because there is a cost to working capital, which is why our goal is to optimize it and not maximize it. Because if we were to maximize it, we're also maximizing that cost. So now once we do that, the fields are populated for you. So we see we have revenue of 10,000, cost of goods sold of 1,500, gross margin of 8,500. Once we deduct our holding costs, we have a net income of 8,190. If we look here, over the long run, our cash is eventually going to equal that 8,190. But in the short run, we want to know, how are we doing? Because over the short run, we have bills we need to pay. So when we come to liquidity, we have cash of 1,690, accounts receivable of 7,000, inventory of 3,500, and accounts payable of $4,000. Our working capital is 8,190. Well, that tells us that over the long run, we can cover our current liabilities. But what are the short run? Cash is only 14% of our current assets, 1,690. Well, our bills are probably going to come due within 30 days, because the way the cycle runs, after you buy your inventory and sell it, by the time you sell it, but at the end of that cycle, accounts payable normally comes due. So in that period, you have a cash shortage of 2,310. Even though in the long run, you're going to get the $8,190, in the short run, you have a shortage that you need to fund. What if this business should increase their percentage of cash sales to 40% or 60%? See, at this point, they don't even have a shortage they need to fund. So the whole point of the working capital is to tell us, okay, I know I can fund my liabilities. So it shows like, okay, eventually I'm going to collect enough cash to fund my liabilities. But to really get good picture from this number, we need to work with a number of days. And we've talked about the activity ratios and how to compute your number of days of accounts receivable, accounts payable, and inventory. And we need to work, those two ratios have to work together to get a clear picture of exactly what needs to be funded or what you need to be funded. The whole goal of working capital is to be funded enough where you're able to increase profitability, because obviously if you're not giving receivables, you might be reducing your sales somewhat. So but you don't want to get to a point where you always need external funding. So you want to find a place where you optimize, where within the current period, you are the positive. And at that point, that's where you're optimized. So when you start being too much in the positive, you can actually play around and say, okay, maybe I can increase revenue by increasing receivables, but not too much where I'm in a decline. So overall, when you properly manage your working capital, you can actually see revenue also increase as a result. Liabilities reduce as a result, because and then not even having cash problems, which is why it's very, very important to really sit down and think about it. And you have to balance things from your customer's perspective and the internal business perspective. Let's see what happens when a business is growing too fast. So let's say this business here grew from 100,000 to $1 million in a year. Because of the fast growth, they don't have as much time to collect on their sales. That's when the first thing that happens is when they're growing really fast, they're not really paying attention to working capital. So accounts receivable might be going up. And so even though sales is going up, at the same time, they're having to buy more inventory. And then the cost of holding that inventory, I mean, it could be minimal, it could be more, but the cost of accounts receivable would probably go up. Also, the cost of accounts payable would go up because they'll probably have a whole lot more late payments. And so what happens as a result is, even though they're generating profits, as we can see here, profits of $759,440, the cash flow, they have a huge cash need, like $500,000 needing cash every month, because even though even in the long run, the cash flow is going to match their profit. In the current period, they're always going to need more cash they can generate, just because of, they're not managing the working capital right, because of the need to finance new inventory so they can meet those sales, or the need to not paying attention to the accounts receivable like they should. So growing at a very fast rate could actually be detrimental to a business, because it limits the cash. And if they cannot get external cash funding, then they're really, really very limited. So at this point, it will be advisable to bring in a CFO or someone who really understands the numbers and can pace the growth in a way where the business does not go out of business trying to grow. Now, let us take a look at how this works for a service business. Well, in the service business, there is no inventory, but what's the biggest thing that needs to be managed? It's payroll, the cost of providing that service. So that's the big thing that a service business needs to make sure that they have every month. So here we see revenue collections every month is 50%. Um, the cost of labor is 4,000 per month. So they need to make sure to manage working capital so every month they can meet that cost of providing that service. Because remember, working capital has to do with the direct costs involved with making your final product or service. We're not talking about the other costs like your rent and others, other things that are not directly related to the production. We're talking about direct relation to production because that's what we're looking at. So if we're managing working capital as a service business, we want to make sure that whatever we need to make sure our customer gets what they want is properly managed. Because if we're not paying our employees, they're not going to be around for too long. So here we see revenue is 10,000, cost of labor is 4,000, the gross margin when you take away the cost of providing the service is 6,000. So cash is 10,000 from cash from because they collect 50% down, so they collect 5,000, then accounts payable is 5,000. Accounts payable is 4,000. That's what they have to pay that month, and that's our total current liability. So here our working capital is 6,000. So for this business, we can see that they actually have enough cash to meet their, they're going to have enough cash. They have a surplus to meet their working capital needs. Now, however, what happens if the cash percentage goes down to 30%? So if they're not paying attention to the collection, they're so busy, they get really, really busy, they're not paying attention to collection. All of a sudden, they have a working capital shortage. Well, this business could have been profitable. I mean, it is profitable, and in the long run, it's eventually going to, other things being equal, they know bad debt, whatever, other things being equal, eventually going to collect the 6,000. But in the current period, they're going to be short, and then they'll need some kind of working capital financing because they're not paying attention to their accounts receivable. So let's summarize everything we've just learned. Working capital is a balancing act. We're balancing safety, liquidity, and profitability. Over the long run, liquidity and profitability equals each other, but in the short run, this is where we're really concerned about. In the short run, can I be liquid enough to meet my needs? Without adequate funding, you will collapse. If too much funding, then you're not really efficiently managing cash. You got to remember, our goal here is not maximization of working capital. Our goal here is optimization. We don't want too much and we don't want too little. If you want to learn more or you want to learn how to build your business in a way so that eventually you can actually retire from your business and your business can fund your retirement, then please go to retirefrommybusiness/download and download the PDF and Excel file to help you get started thinking about the process. You don't want to wait till it's too late before you start thinking about walking away from your business because you never know what the future holds. You might get sick, anything could happen. You need to start planning for that now. And the best way to plan for that, if you have a business, is to make sure you have a strong business.